Well, good afternoon, everyone. This is Mordecai Evans with Business Acquisition Advisors here again to discuss another topic in M&A. If you remember from my last video, our topic of discussion was the value of a business. What constitutes the value of a business? What is my business worth? And if you remember, we discussed that the ultimate determinant of value is what someone's willing to pay for it in the marketplace. However, we also discussed that to come up with an estimate of value that most small businesses are valued as a multiple of the earnings. And we talked a lot about multiple, but we didn't talk at all. And I said we would table the earnings component for a later date. Well, today is a later date, so we're going to talk about earnings today. So let's go ahead and jump in. So today we're going to talk about the what, the how, and the why behind earnings in the M&A space. So, what constitutes earnings as it relates to M&A and business brokerage? The first question. Well, in our world, we utilize two primary terms to describe the earnings of a business. The first term is SDE, and that stands for Seller's Discretionary Earnings. The second term is EBITDA. EBITDA. I'm pretty sure most of you have heard of it. Very strange term, but it stands for earnings before interest is deducted, taxes are accounted for, depreciation is deducted, and amortization is deducted. So I want to be more specific today as it relates to EBITDA, and we're going to go a little step further and use the term adjusted EBITDA. And we'll get into how we get to that number, but I believe adjusted EBITDA gives us a better and a clearer picture of what the earnings of that business are. Now, a word of caution. Sometimes both terms are used interchangeably, but they are not the same. So as you're having conversations with people about the earnings of a business, make sure that you're talking about the same adjustments and that you're comparing apples to apples. Well, the second question, how do we get there? How do we determine adjusted EBITDA and SDE? Well, the first thing we have to do is we have to adjust or normalize the net income of that business. So we want to take a look at the P&L, look at the net income, and then we want to add back the interest, add back depreciation, add amortization, but don't account for the taxes. The second thing we must do is to add back any non-reoccurring expenses or any non-operating expenses or any one-time expenses or discretionary expenses. For example, let's say you had a legal matter that you had to deal with one year, and the legal fees were for $50,000. Well, we make an adjustment to that $50,000 and add it back because it's a non-reoccurring expense for the business, non-operational. The third thing we must do is add back the owner's compensation to that number. And that gets us to our SDE or seller's discretionary earnings. Now, both SDE and adjusted EBITDA are calculated the same way. The only difference between the two is adjusted EBITDA accounts for the fair market value to hire a manager to run the business. Give you an example. Let's say we do our calculation on this business and our SDE is $600,000. But as we evaluate the business, we determined that in order for us to hire a manager to run that business on our behalf, it's going to cost us $150,000. Therefore, our SDE is $600,000, but our adjusted EBITDA is $450,000. So that's primarily the difference between adjusted EBITDA and SDE. Well, the third question, why do we have both these terms? How do we use them? What's the difference? Why we use one versus the other? Well, SDE is primarily used in smaller Main Street businesses and businesses with revenues of less than about $5 million. And it's primarily used in the business brokerage space. And SDE assumes that owner is going to be the owner operating that business. They're going to be there every day running that business, and they're going to be physically there present, and therefore all of the funds would flow directly to that owner. Now, adjusted EBITDA It's used primarily in larger businesses and businesses that with revenues of 5 million or more. And it's primarily used in the M&A world, M&A space. And adjusted EBITDA assumes that a larger company is going to purchase that business and they're going to hire a manager to run that business on their behalf. Therefore, that's where the adjustment of the fair market value of the owner's salary comes in. So that's the primary difference between SDE and adjusted EBITDA. So as we kind of wrap our conversation up around business value and those factors that determine value, again, earnings, a multiple of the earnings. There are some. With all that said, there are some things that you can do to enhance the value of your business. If you'd like to have a conversation about some of those things that you can do, if you're a business owner, feel free to direct message me for confidentiality purposes. If you're a professional advisor and you have a client that needs some help or wants some feedback, you can reach out to me as well. And also, as always, feel free to leave a comment in our comment section or ask a question in our comment section of a topic that you want to hear about in the future. Hope this helps. Until next time, this is Mordecai Evans, Business Acquisition Advisors. God bless.